not that Jeremy, different Jeremy. Jeremy Rubicon. I have a potential loan request for you.
This is good timing because my sports one had to get pushed off to 5 p.m. instead of earlier.
Oh, good. So you're ready to rock and roll?
I'm ready to rock and roll.
Oh, yeah, I didn't have time to scour the blog, so I'll just be winging it. But hey, after 5 years, just make it up as you go along.
That's it. And I still have to figure out a way to do this thing with you with Marcy. You guys sent me a check, and we're going to cut her a check. And I don't know if there's a way to have you guys hold on to an unrecorded deed or something.
Yeah, we can hold on to anything. Yeah, I don't.
Okay. But can you cut a check to her though, in the future? If it's an unrecorded deed.
Say that again.
Okay, so you're writing me a check every month.
Yeah.
Can I say, well, pay some of it, just have, that way it looks like it's all, she's getting her own check.
I don't think, that's the thing, again,
we don't have to do it right now,
Yeah,
we cut her a separate check,
yeah.
let's get into our recording and
yeah,
we'll figure that out.
that's, my brain has now gone into complete fuzz mode.
Let's go into
all I know is that it's got the girls all completely, like their panties in a wad, they're complaining they don't like it, they're upset, and I don't know any of the laws, and I don't want to.
Yeah,
so,
I know.
So, so don't ask me if you can do it. If
Gotcha.
Debbie and Mirka say you can do it, great. If they don't say, can you make them do it?
No, I won't. No, I don't want to cause problems.
Yeah, there's.
It's just that when Mirka wants me to pay her like $15,000 to do this, I go, no, not that.
Well, her dock draw fee is like $1,500, and so we don't, it doesn't make any sense, and that's why I've flat out given up on these things, because I end up paying out of my personal pocket the money to do have it go through escrow, have it recorded, do the 104.1 endorsement. It's like there's no money in it doing that. I mean, down the road, the AV thing might make a lot of sense when we've got $1 million loans in the fund because we're at 30, 40, 50 million. But right now, it's
no, I know.
it's a massive
I'm
distraction.
just gonna have to do it.
Yeah, I don't have the bandwidth for it. So
yeah, and the title company's not making it easier on me.
No, they don't. No, they're not easy to do. What's going on here?
They're being very, very nasty.
Yeah.
Okay, are we ready?
Oh,
Okay,
God,
excellent.
Good radio.
On time and everything.
I printed out who would be better for mortgage financing, Clinton or Trump.
Oh,
and
awesome.
I left it in. I didn't print.
What do we think?
That's okay. What do you think?
We can make it up.
Was it this one?
No, I just wanted to put that in front of you. Stuff to talk about.
Yeah, okay.
And then, Mark, I've got your email here. It says, how can your fund be liquid and yet the principal doesn't fluctuate?
Okay.
I like that.
The principal doesn't fluctuate. Oh, the payout?
Well, it doesn't, because it doesn't get traded like a stock. So the principal isn't fluctuating up and down.
Oh.
Yet it's liquid because people can get out with an early penalty.
Yep, got it.
And such. All right. So after I do my intro, who wants to start? I can just go right into email if you want.
Yeah, why don't we do that and see where it takes us?
Okay. Here we go. Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hahn of Pacific Private Money, one of California's fastest growing mortgage investment firms, and Rob Spinoza of RPM Mortgage. Now, our phone number is 888-912-1190. Now, you're going to use that number to answer the trivia questions for 3 vacations given away during this show. The vacations are not sponsored by the radio station, but by Lighthouse Resort Marina, located 1 hour northeast of San Francisco. Those vacations are free. Their only request, a $75 cleaning fee to cover the housekeeping expenses.
Easy for you to say.
Yeah, it used to be. I don't know, I should have memorized this thing by now,
After 5 years, you would think so.
You would think so. And people say, what's your show about? Well, it's a bunch of guys hanging around a bar. Of course, we're not at the bar. Having drinks. Well, we're not having drinks, but we are talking business. Okay.
Shooting the stuff.
Shooting the breeze. Yeah. Okay. And today's trivia theme is really kind of interesting. Coffee quotes in the movies.
Oh.
Coffee
quotes in the movies. I had the first part.
In the movies, yeah.
I am a serious coffee drinker.
All right. Okay, so let's see here. Rob, we got a bunch of emails, and some of them are very poignant. So
kind of neat starting out the show with email questions.
Yeah, get you right off the bat. Okay.
Get you back on your heels right out the gate.
That's it. Okay. Are you on your toes?
Yeah, I'm on my toes.
All right. We'll hit you with this one.
All right.
Do you always look at 2 years tax returns for qualifying for a mortgage?
Great question. So I deal with residential financing. So 1 to 4 units, primary homes, secondary residences, and non-owner occupied rental property. But 1 to 4 units. So when you go to get a loan for those nowadays, the standard is 2 years of tax returns. So we will, in most cases, certainly in the case of a jumbo loan, we're going to ask for 2 years of tax returns. But there are some exceptions where you will not be required to provide 2 years of tax returns. And what's really interesting about this, when that came out, I don't remember what year it was, but it's a Freddie Mac feature. So in conventional lending, you have Fannie Mae and you have Freddie Mac, the two government-sponsored entities. They both have slightly different guidelines, although for the most part they're equal. Freddie Mac has an exception for a self-employed borrower where you only need to use 1 year of tax returns to qualify. So this can be extremely beneficial because typically with a self-employed borrower, the way we view things is we'll take a 2-year average if the average is increasing. So if your 2014 was better than your 2013 at this time of year, and your profit and loss for this year supports that, we'll use an average of the 2 years, okay? But if your 14 declined from your 13, then in that case, we would use just the 12-month average on your 14.
It's like pay no attention to this.
So it's
to the man behind the curtain.
disadvantageous to the borrower. But in situations, let's say you're a self-employed business owner, you're getting your business off the ground, and 2013 was your first year. 2014, you did a lot better.
Yeah.
Now with that Freddie Mac exception, you could just show 2014 and qualify off of that.
And as the rest of it, it sounds almost like the old stated income.
Well, it's not stated income because you still have 1 year of documented, it's not the whole picture, but then who's to say if you included a third year, you'd have a wildly different scenario for some self-employed, right?
But I mean, let's say 2013 is an okay year.
Right.
Or actually, let's say 2014 is an okay year, and 2015 we haven't done yet. Right?
Well,
We're
right.
not finished.
Okay, but
Stated income. Hey, I'm making $1 million a month.
well, that's where your profit and loss was. No, you
And
can't.
I'm a postman.
that was what was it? The stated wage earner. It's
Yeah,
like
cab
I don't know,
driver
but it's
Stated wage earner.
we had that program countrywide. I mean, they
Stated
weren't
wage
they
earner.
weren't the only ones.
The ninja loans, right?
Right.
No
Well,
income, no job, but lots of income.
so we'll talk about that one in a second. So anyway, getting back to your 1 year of tax returns in that case. So that feature was actually extremely beneficial until they overlaid it with another requirement, which was the loan application needed to state that the person had been self-employed for more than 1 year. So where people were really taking advantage of that 1 year exception was for the newly self-employed. And as we all know, when you convert or when you become self-employed, typically it requires a 2-year history. Now, one other thing on that item. What was tripping some people up in our industry that were not careful was they would have a self-employed individual, they would use 1 year of tax returns, but on the tax return, they'd have a rental property. That would require that you bring in 2 years because that shows on your Schedule E, okay? And you need to average your rental property income over 2 years. So even if they had the income piece figured out, the rental property would trip it out.
So
All right?
Rob, I've got a question for you. So this is kind of related to what we're talking about. So I'm what you're talking about sounds a little bit complex.
Yeah,
If you're out there driving around listening to this, it's kind of like
Pull over to
I was
listen.
yeah right. I was, your eyes start to spin around, going, wow. And it's funny because on the drive to the studio today, I get a call from an investor who actually tells me a story about a friend of his who just refinanced his home, and I won't name the name of the company. And again, you're here with representing RPM Mortgage on behalf of yourself, Rob, and. But I was intrigued to hear that the so-called friend, and I don't believe it was a jumbo loan, but he was able to do the loan with 1 year, not 2 year tax returns, and of his FICO scores, they picked the highest one, not the blended one, which I thought was interesting. And there was a couple of other features but the point of it was what I was hearing was, wow, okay, so some lenders now are starting to get a little creative, maybe in order to drum up more business. As we see now, the refinance activity is going down, purchase activity is down.
Yep.
Lenders are still in business to make loans, and notwithstanding all the Dodd-Frank new regulations and TRID and all these other crazy things that are making it harder and harder for borrowers to borrow money, there's still lenders out there that are looking for ways. Okay, well, how can I not go back to the crazy times of 2005 and 6, but maybe give our borrowers a little bit of a break. So are you seeing that trend happening at all?
I am seeing that trend, but it is a trend at the end of the day that is tempered by ability to repay, as you know. So that,
Well, absolutely.
yeah, that's
No.
so
agreed.
if a lender says we're going to work off the highest FICO instead of the middle one, then they've got to prove a case that they determined from that borrower that was not creating an undue risk, and that borrower had an ability to repay.
And it's really only upon an audit that they have to actually prove this stuff, right?
Well, an audit, but in our case, an audit, in our industry, an audit is more represented by a buyback. Okay, so the end investor or whatever says, I don't like this loan. It's just some attribute of this loan is turning me off. You originator, you're going to buy the loan back.
Is it each loan gets analyzed, or they just randomly pick?
We do get some post-funding conditions. So basically, and again, RPM is a conventional and a jumbo lender. So we're doing mostly paper stuff. We're going to sell it to an investor at the end of the day, and that investor is going to review the funding package that goes into them, or the closing package at that point. And they're going to say, okay, you missed this bank statement, or whatever it is, and they're going to come back because they're looking for a deal when they hold that loan. They're looking for a bulletproof deal. So if there's ever some sort of defense leveled against them, they can prove definitively in a court that they had ability to repay. And that's what what Dodd-Frank has driven into the industry.
How many loans have you guys had to buy back?
I don't know the stat.
Oh.
Yeah, I'm not privy to that information. I'm sure I could ask for it and find out, but as an originator, I don't see that side of the business.
Okay. Before we cut over to Mark, because we have an email that we want to get to him in the next break here. Give us your information, because we have another great question for you that we're going to ask.
So my bio is on the Best of Investing website. You can find it there. I work out of the Mill Valley office of RPM Mortgage. We're right on the 101. You can probably see our sign as you drive up north or south, depending on where you're going. And 415-367-5959 is my phone number.
Very good.
Yeah, call anytime.
All right. So we're going to cut to our first commercial break. Is that okay?
Oh, heck yeah.
Oh, yeah. Okay. Before we do,
Stay tuned, please.
Stay tuned. Yeah. We've got. So there's this gentleman. There's this doctor named Dr. Vadim, and he's got San Francisco and San Jose offices. He's got a special deal going on, especially for our Best of Investing.
What does a good doctor do?
He does dental implants.
Oh, okay.
All right.
Awesome.
Pretty good. Get this. He does these implants, the whole thing, for only $1,998. That sounds like a really good deal, because I used to specialize with dentists, and I know they.
I remember
Yeah,
my
expensive.
braces back in the early '80s cost my parents $2,000, so that's a pretty good deal.
Yeah.
Today's dollars.
Yeah.
Yeah.
Oh yeah, because braces are
Yeah.
$6,000-7,000
Yeah.
now. So he's offering low prices because he wants to attract new patients and hoping satisfaction will get people to stay there. So check him out, www.smiledelightdental.com. You can call 415-992-5160. Leave a message, he'll call you back first thing Monday morning. All right, so here's our first trivia question on coffee quotes in the movies. Are you guys going to go on coffee?
I'm amped up.
I got to get that. Yeah, got to amp up. There's a lot of caffeine. Here's a caffeine question for you.
Okay.
In which 1995 crime drama is Kevin Spacey heard to utter, "Back when I was picking beans in Guatemala, we used to make fresh coffee right off the trees"? You have to have seen the movie to know that one. You know that one? Oh,
I have
Mark
a
thinks
guess.
he knows this one. All right, the first caller with the correct answer is going to win a free 3-day tuna. You have to call faster than Mark can. A free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer this question. In which 1995 crime drama is Kevin Spacey heard to utter, "Back when I was picking beans in Guatemala, we used to make fresh coffee right off the trees"? See, there's your coffee in the movies. All right, stay with us. You're listening to the Best of Investing. Don't touch that dial. We're going to be right back.
Guys, they're so sick. I think it was when he was. Who is Kaiser Sosa?
Oh yeah,
Yeah.
that's right.
Kaiser Sosa.
Kaiser's like, yeah, that's right. Very good.
I can't remember the name of the movie though.
Not A Few Good Men. It's of course, the name of the movie is the tip of my tongue now.
Yeah, I know. It's
That's the whole idea. Get you to go. Kaiser Sosa. I finally saw the movie. I hadn't seen it.
Oh,
It's pretty good.
yeah, it's really good. I thought.
You know what's a really good movie? Did you guys see American Hustle?
Oh,
You know what? I never actually.
Oh, it's a good movie.
Is that a good one?
Yeah,
Okay.
it's really good.
Is that Kevin Spacey also?
No, that's Bradley Cooper and Christian Hale.
Okay. You ready?
Yeah.
Let the baby go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. When we get to the first commercial break, we asked this trivia question about coffee quotes in the movies. In which 1995 crime drama is Kevin Spacey heard to utter, "Back when I was picking beans in Guatemala, we used to make fresh coffee right off the trees"?
That was a great scene uttered by the infamous Kaiser Soze from The Usual Suspects.
That's it, The Usual Suspects. Very good.
Good job, Mark.
That's excellent. That's a good movie. I like that. Okay,
Absolutely.
let's see. Mark, trivia. This is not trivia. This is an email question we got for you. How can your fund be liquid and yet the principal doesn't fluctuate? This is someone who's listened to the show a few times.
So for you new listeners out there, you're listening to The Best of Investing. You've got three real estate guys today with, I'm Mark Hunt, with the broker and president of Pacific Private Money. We are hard money lenders, of course, and we've got Rob Spinoza here for RPM for your conventional lenders. And Edward, you did quite a stint there back in the day, hard money lending too. So we got a little real estate show going here, and at Pacific Private Money, we make privately funded real estate loans, usually short-term bridge loans and stuff like that, loans to people who are buying, fixing, and flipping. There's all kinds of reasons why someone would want a short-term, fast, non-bank financing. Sometimes they can't get money from a bank. Sometimes they can, but they just need the speed, have a need for speed. So we have a couple of ways that we finance our real estate loans, and both of them involve private money. We work with individual investors who like to invest in individual notes, and then we also work with investors who are less experienced in investing, and they would rather invest in our mortgage pool fund. It's like a mutual fund of mortgage secured notes. So a couple of different ways. Directly invest in a note or invest in a mortgage pool fund where the fund manager, which is us, makes the loans. And so we've been in business since 2008. We've done over 1,000 loans, totaling over $200 million, all short-term loans, mostly here in Northern California. And so the email question had to do with regarding our fund. So how our fund works is that we pool money together from investors and make real estate loans, and our fund pays a preferred return plus a portion of the profits. They're split with the manager. It's kind of how mortgage pool funds work. But the bottom line to you is, and what you probably would care the most about, is that that fund has been paying a little over 8% consistently for the last 30 months that it's been in existence. And so, past performance is no promise of a future result, but we do believe that based on the fundamentals of the fund and the demand for short-term capital and quick funding loans, that we believe we will continue to pay out a little over 8% yield to our investors. That's a monthly distribution, although it's an annualized rate. We pay monthly, and the 8% yield is pretty strong. So the question had to do with
liquidity.
Yeah, with liquidity, basically. So it's a mortgage pool fund is typically not traded like a stock or a bond. So it's not considered a liquid investment. However, because of the nature of our fund, we've got short-term loans that pay off and the cash goes back into the operating account. Also, we continually get new investors that come in. So at any given time, our fund will be sitting on a stash of capital. In fact, like for example, today we have a little over $1 million in the fund in the two accounts that make up the fund. And so That money is generally pledged to do loans, and we've got a few loans closing next week that we've got much of that money pledged for. But also, from time to time, we get redemption requests, and someone will say, okay, well, I want to, I've got a $50,000 account, I'd like to cash that in. And so, if the liquidity is there, we can cash that in fairly quickly. And our units are priced at $1,000 a unit, and since we are making loans with that money, that $1,000, although in theory can fluctuate, in practice it doesn't, because we're making loans that are well secured with conservative loan to value, and so that $1,000 per unit share price is pretty reliably consistent.
Well, unlike a REIT that gets traded on the stock market, it's subject to interest rate changes, how the stock market, if it crashes or goes up or down. You don't really have that. I mean, if someone invests $50,000,
right, it doesn't.
They're going to get their $50,000 back less an early withdrawal penalty.
Right. So stocks can go up and down. Bonds can go up and down. REITs can go up and down. When you invest, $50,000, $100,000. Our average investment is about $200,000. Our average account is $200,000 in our fund.
That was going to be my next typical investment.
Now, it can go down, but for it to go down, we would have to suffer a principal loss on one of our loans, and it would have to be sufficient that it would eat up all of that month's profit or the retained earnings that we have in the fund. We also have a loss reserve in the fund, so a number of things would have to happen, which of course have happened before. We did have a severe downturn, of course.
Not with your fund, but just in general.
Not with our fund, but in general. Funds have, people have invested in mortgageable funds and have seen loss of principal, but typically those funds were investing in land or speculative types of notes or seconds.
Or they were leveraged.
Or they were leveraged funds. And so what we've done differently with the Pacific Private Money Fund is that we stay away from speculative loans. Yes, we'll do seconds, but we like to see very, very low combined loan to value with lots of equity in the property. And we're not doing land or development deals because, again, the type of demand we're serving today is different than the demand 10 or 15 years ago. So it's really a much different universe for private money lending, and for mortgage pool funds that are created in the last 5 years. What we're seeing is very strong earnings. We're seeing generally conservative loan to value, and our particular fund, as you mentioned, Edward, is not leveraged, so we're not borrowing against the assets of the fund to try to boost the yield with say maybe a 3 or 4% warehouse line of credit, which some funds do. So
yours is a true yield.
It's a true 8% yield.
Invested not from the beginning, but almost from the beginning. And every month I get my statement, and sure enough, there's the mortgage check going.
So if you don't know what we're talking about is something that's referred to as mortgage investing. It's also sometimes called trust deed investing. The Pacific Private Money Fund is a mortgage pool fund. If you want more information about how that works, give us a call or shoot us an email. Phone number is 415-883-2150. That's 415-883-2150. You could get all of our contact information and email information by going to our website, which is pacificmoneyfund.com. That's pacificmoneyfund.com. And we're very a soft sell. We're more about attraction rather than outward promotion. So of course we're talking about on the radio show, but again, this is about if you're looking for ways to boost the yield in your retirement savings, check out our website, pacificmoneyfund.com. We'll send you some information in PDF format, follow up with you, and if you want, if this is for you, then we can go take it from there.
Well, the thing that cracks me up is the fact that in 1 month you earn basically, right now, let's say it's paying 8.4% on a compounded yield. That's 0.7% in a month. How long would it take? That would be more than like 6 years in a bank, in 1 month. And people say, if I were somebody who didn't know, I would question, okay, well, how do you get out, right? Well, the thing is, either A, there's already cash sitting in there ready to deploy, so if anybody wants money out, they can get out that way. The other thing is, there's constantly new investor money coming in, so you can get paid off, and it's not a Ponzi scheme, right? It's just new investor money going in. The other way is that if a loan pays off, Mark will have funds.
Oh, that's right. Boom.
Right? Yeah. You can pay it off that way. So there's potentially lots of liquidity. In fact, have you had any redemptions?
No, actually, that's
Okay.
that's.
I mean, who wants to redeem? You're
Well,
earning
people
over
call.
8%.
People have been starting to call and saying, "Hey, my 2-year period is up. What's the redemption process?" And I just tell them verbally what it is. It's very, very simple. Just call me up and say you want to redeem 25, 50, 100,000, whatever you want to redeem, and we'll put it in the queue, and we can get that cut pretty quickly if we have the liquidity.
And for those who don't know, but when you mentioned about the 2-year mark, it's if you stay in for 2 years, there's no prepayment penalty.
There's no
withdrawal
charge.
penalty.
Yeah, there's no load going in or out of most well-run mortgage pool funds, and of course, at Pacific Private Money Fund, we have no load going in or out as long as you keep the money in for 2 years. So yeah, what you were mentioning is like we pay more out in a month than most people are earning on their money market accounts on an annual basis right now. And I have phone calls, conversations with people every day who who have pulled money out of the stock market because they're just not comfortable with what's been happening over the last 6 months there, and they're looking for for ways to put that money to work, and they're just really frustrated by the fact that they just can't get any kind of yield from money market accounts or CDs.
Well, and 2 years is not a long time, but if you're in for, and I use this example, 13 months, your penalty would be 3%. But if you're earning 8.4%, let's say, let's 3. I mean, okay, so you're still ahead of the game, 5.4%.
Well, I wonder too now how much this is, how much people are going to be looking at investments like that when you not only take the stock market where it is and where it could go, but also now with the interest rate risk. When you're looking at other things out there, what's the Fed going to do? We see that now every day. The last 2 days, in fact, have been quite volatile on the market because yesterday's Fed statement, they kept rates where they were. No change there, but the language in the statement strongly indicated that they would be considering an increase in December.
Okay, when we come back, I do have a question for you about taking a 15 versus a 30-year mortgage and what's on that.
Yep.
And before we go to the break, this segment of The Best of Investing is sponsored by Pacific, not only Pacific Private Money, but we also have Pacific Trade Exchange.
Oh, right.
Awesome.
Yeah.
Love those Pacifics.
I know, those Pacific. Yeah, in fact, Patty's with Pacific Union Realty.
Residential Pacific Mortgage.
There you go. Yeah, that's right. Yeah, well, we are on the Pacific
RPM,
coast, right?
yes,
Yeah, so Pacific Trade Exchange is basically it's a barter exchange. It's just another way to do goods and services without using money out of your pocket. And I understand that a lot of companies have been very successful using it. Like restaurants, they have food that they just can't. They don't want to throw away,
Right.
So they throw it on the barter exchange, and then they get people to to fix the roof or mop the floors or whatever. So
Love mopping those floors.
you got to check them out. It's very, very interesting. Pacific Trade Exchange, and Brian Capehart is the gentleman to contact. But look him up, packtrade.com. Okay, so here is our second trivia question about coffee quotes. All right, mark up the first one. See if you guys can get this one now. In the 2001 movie Black Hawk Down, what is the name of the actor who says, "It's all in the grind, Sizemore. Can't be too fine, can't be too coarse. This, my friend, is science." All right, the first caller with the correct answer wins a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. Again, don't touch that dial. We're going to be right back. You're listening to The Best of Investing. We got a great question for Rob Spinoza when we return.
I read that book. I didn't see the movie though.
You know, it's funny. I saw the movie and I didn't like it, and I like those kind of movies.
Yeah.
Like
Which
Platoon
was
great.
it?
Platoon was
Black Hawk
awesome.
Down,
Oh, Black Hawk Down. No, I didn't see that one.
not worth it.
Platoon was
Black Hawk Down. Black Hawk Down was just okay. Full Metal Jacket was supposed to.
was not a great movie.
Terrible.
Yeah.
Yeah, Full Metal Jacket.
It had great scenes in it.
Some of the scenes were great, but the movie
The
overall
opening
was
scene
classic.
was classic.
Yeah.
Harley Ermy.
Yeah.
I will shit down your neck.
You know what? That also comes. You know what that line also comes from. Stand By Me.
Oh, really?
When one of the kids yells at the old man. Oh, remember, we are recording, so be nice.
Yeah, I know. I didn't realize.
Oh, what about your eyes?
that
I'll
scene
do it.
goes
I'll
on.
do it. Yeah, I forgot like the whole thing.
Yeah.
I know what a Full Metal Jacket is, but I forgot the whole movie.
Yeah, the movie wasn't that good.
The Platoon was.
Platoon was worthy of Best Picture. Won Best Picture in 1986. That was,
You even remember the date.
yeah, it was a great.
Deer Hunter, that one best picture did it too.
Deer Hunter, I didn't think was a great movie.
I didn't
think it was that great.
Yeah,
I'm surprised it wasn't Academy.
I also didn't
It
think.
was also around that time, wasn't it? Wasn't it the Vietnam War and stuff?
Yeah.
Excuse me.
I also didn't think. What was the other Vietnam movie that everyone raved about? I didn't think it was a good.
Good Morning Vietnam? No. The one with Sean Penn. Oh, we got a whole bunch of those movies.
Yeah.
Okay, here we go. Welcome back again to the best of investing. Edward Brown here, along with Mark Hahn and Rob Spinoza. Second trivia question about coffee quotes in the movies. In the 2001 movie Black Hawk Down, what is the name of the actor who says, "It's all in the grind, Sizemore. Can't be too fine, can't be too coarse. This, my friend, is science."
Don't know. Didn't see the movie. Read the book. Liked it. But
Yeah, I guess if you read the book but didn't see the movie,
Yeah.
it was Ewan McGregor.
Ewan McGregor.
Oh, sure.
So he is Ewan, not Evan, but
Ewan?
yeah,
Whatever.
E-W-A-N. Okay, Rob, quick question for you here.
Sure.
Thinking about refinancing one more time before rates go up.
Yeah.
Should I get into a 15 or a 30-year mortgage?
The answer is, of course, highly individual. So, it depends on where you are in your life, where you are in your finances, all that kind of stuff generally plays into my assessment of what somebody should do in that situation. I think the real question cuts to another fundamental issue of what's more valuable to you, saving over the term of the loan or the flexibility in the payment. So,
What are the rates between the two?
the rate is usually about a 0.5% spread. Okay, so if you could get a 3.75 on a 30 today, you would expect to get a 3.25 on a 15. That's about right, I guess you could say, on a conforming loan. The deal is that the payment on a 15 is substantially higher, and the reason for that is the term is shorter. You're paying more principal with each payment, and you're paying less interest. So it's appealing because you can have the loan paid off in half the time, and in doing so, you can pay far less interest. Okay, simple math. But the problem with the 15 is, for some folks, they get to that point where they're interested in doing it at a point in their career where they may soon be retiring. So their income will change, and they'll be stuck, if you will, with that higher payment. Now, the goal of paying off the loan is that much closer, and good for them for that. But the problem becomes, how do you continue to make that payment if anything comes up, a medical emergency, you have to put a kid through college, whatever it may be. A 30-year fixed can give you additional flexibility that allows you to make that. Now, you can always get a 30-year fixed and pay it as if you were on a 15, and the difference there would be that 0.5%. But what I tell folks too is, let's say you take the 30 and you could have gotten the 15, as long as you can get with that savings difference, as long as you can earn a 0.5% on it, you're kind of bringing yourself back to parity on it. So it can be another way to think about it as part of your overall financial plan. It's a valuable tool for flexibility to go into another 30.
And is there still a pretty, attractive spread between the 30-year and the 15? Because I hear advertisements on the radio, and I hear them still like in the low 3s.
Yeah, it's in the low 3s for a conforming 15-year, and it's roughly in the high 3s. So it's anywhere from a 0.5 to 3/4 difference in the rate to get a 15. So again, a lot of incentive to shorten the term, lower the interest rate, and do that. But one thing that I think is usually enlightening to a borrower when I talk to them, and I give a perspective on the industry, is this. So if you were talking to me 10 years ago, I would have told you that the spread between a 15 and a 30 was 5.5 to 4.75. Okay? And if you were intent on getting that 15 because of the interest rate, you would have been clamoring to get that 4.75, right?
Yeah.
Because you're like, I got to get into that 15 lower interest rate, all that matters. Now, the scale is just different. Okay, and now you're talking about a low 3 versus a high 3. But think about yourself in 10 years ago, you would have clamored to get that 4.75. Now I'm telling you, you can get a 3.75 on a 30. So it really more depends on where the industry is and where the economy is than necessarily the difference between the 30 and the 15. I think you have to think of it that way.
The other part of this is, a lot of people don't realize this. Now I remember that this was when interest rates were like 12%
Right.
on a 30-year mortgage. After 25 years, you still owed half
Of the principal
of the
balance?
principal
Oh, I would think it'd
balance.
even be more than that. On a
on
yeah.
a 30-year.
After 25 years.
25 years.
Oh, after 25. I thought you said after
No,
5 years.
after 25
Yeah,
years,
yeah,
you
yeah.
still
That
have
makes sense.
because
Okay,
it's like
yeah.
almost all principal amount.
Right.
So I was just doing a little calculation here that on such a low interest rate of 3,
Yeah.
4, 3.5, something like that, you would be at after 223 months, which
Okay,
is
it's 20 years.
roughly
Yeah.
pretty close to 20 years, you'd be at half.
Okay.
But on a 15-year, it's about after 8 years.
You're at half.
It's about half
Yeah.
of the of that
Yeah.
period. So it's really you kind of look at that and go, gee, I could only owe half the money in
Right.
8 years.
Right.
So Rob, so the
Good-
looking at this
Good point.
looking at this index, sheet you brought in here today, roughly 30-year at around 3.8 with the, and again, this is a national average.
Yeah.
So in the 15-year at like 3.2. So maybe a little more than half a percentage points or 60 basis points in financial speak difference. What about the adjustable rate, the ARMs, the 5/1 ARMs, the 7/1 ARMs? Is there any compelling savings in the rate that would drive someone to do that versus a 30-year? And if not, why does anybody even bother getting one of those rather than just a 30-year fix?
Yeah, the 7 and the 10-year ARMs sort of come into their own in the last, I would say, 5 years, and I think justifiably so, because most people, I think the statistic is incredibly high. I think it's like 90% of all borrowers will only be in the same home and same loan 10 years from now. Okay, so if you think about that, for whatever reason, job changes, right, they move or they divorce exactly. So most people do not need the insurance policy of a 30-year fixed rate loan, but of course, many of those same folks sleep better at night knowing that they're never going to face a change in their mortgage payment. And so when you are dealing with a customer like that, of course, I think that's important, and that's a strong sensibility that you have to answer to. However, a 7 or a 10-year ARM the 7 in particular, can reduce the rate over a 30, sometimes by 0.75%.
Oh, wow.
We see a lot of those on the jumbo side, and that's the difference between qualifying and not qualifying, because Mark, as you know, we're held to a hard and fast 43% on the debt-to-income ratio now in the Dodd-Frank era. So if you're looking to buy a higher-priced home here in the Bay Area, you may need that 7-year ARM qualification in order to get you into the property.
I wonder what landlords are looking at from a percentage of rather than 43%, because I in some cases I've heard as high as like 70%.
What do you mean by that?
Well, like a landlord,
The amount of your income that goes to your rent.
Oh,
yeah.
right. Oh, okay. Right.
Yeah.
Right. Yeah.
I mean, I wonder if how much
We're
versus
talking
just-
about being trapped in a renter's cycle.
Yeah,
If you're paying more than 50% of your income to your rent,
Where do you
you're
go?
not saving up for
You're
down
not saving
payment.
for
Yeah,
that.
that's right,
Yeah.
yeah.
And we talk about that a lot in the industry, because that plus student loans plus auto debt are sort of the mighty triumvirate of not owning a home ever. What are you going to do in the Bay Area where prices keep escalating? If you can't sock away enough money to get ahead of that curve, it's really, really tough to be a homeowner.
So what Rob was referring to earlier, just going back to this, number 43%, where does that come from? Well, it was
Yeah.
probably a
Pick that
government
up.
negotiation, where somebody said, well, we want it to be 50, and they said, oh, we want it to be 40, and they settled on 43. 43% debt-to-income ratio is the maximum ratio that most mortgage companies will approve you for that particular loan size and loan rate when they're calculating the loan payment, because in order for them for that loan to be considered in a qualified mortgage, one that they cannot be sued by you if you stop making payments. You can't sue them for making a predatory loan because they've calculated based on your 43% debt-to-income ratio that you make sufficient income to be able to afford that loan. And the reason I'm even bringing this up is that, at Pacific Private Money, we do private money, sometimes called hard money loans. We too, when it comes to making a consumer loan, now I'm not talking about someone who's buying to fix and flip or for business purposes, but if it's a consumer loan transaction, we do in fact still do those loans. We're one of the few private lenders that will make consumer loans. We also are bound to determine that the borrower does have the ability to repay, but we are not bound by the 43% debt-to-income ratio. We can go higher than that. We can go 50, 60, 70. I mean, really, we can look at other forms of liquidity and ability to repay, and under certain scenarios, we may be able to determine that even at a maybe, let's just pull a number out of the year, even at a 75% debt to income ratio for that particular loan, based on other underlying factors, let's say someone's on fixed income and they got $1 million of equity in their home and they want to borrow against it to make some repairs to sell their house. Most banks will say, no, I'm sorry, we can't make you that loan because you don't make enough money. We might be able to look at assets in their retirement accounts and in other things and say, well, yeah, you may, if
they
you had
needed
this
to pull
loan,
$1,000 a month.
right, if you had this loan long term,
right.
Or we wouldn't make you this loan for 5 years because we would be concerned about it being at 75% of your
right.
income. But since you're borrowing it to remodel and flip your home, so again, the point being, a private loan, even though it's expensive money, it averages a 10% rate and a couple of points. It's more expensive than the bank, but there's a lot of flexibility on our side to be able to look at the other income and liquidity and equity.
75%. That's a lot of important beans.
Well, let me give you a perspective on debt to income real fast. How much time do we have? Okay.
We got a little bit of time, right? Because one quick question.
Yeah.
Okay. No, seriously. Is it 43% of your gross paycheck?
Yeah.
Okay, so that's it's not 43% of your net paycheck.
Yeah.
Right.
Because some of that's already going to go to the government anyway.
Right. Well, that's where I was going with this question, or with the answer. So the lender has the ability to control both sides of that equation while the borrower doesn't even know that. And I'll tell you why. Because they set the lender, the industry regulations, they set it at 43%. But a lender, their individual guidelines will tell us how we qualify certain debts that borrower carries. So, for example, all right, if you're a homeowner and you have a first mortgage, let's say you have a $400,000 first mortgage and you have a $100,000 line of credit behind it, but you have no balance on the line of credit, okay, a zero balance. Some lenders will say, we're going to qualify you off of 1% of the line amount as an equivalent payment for that line of credit. So now we're saddling you with another hypothetical $1,000 per month in your debt ratio. So,
because theoretically,
you could take that out, but you haven't, and maybe you even have no history of doing that. But now the debt ratio that the lender has created for you is 70%.
Gotcha.
It's not really 70. So I think I would love to see a return to some normalcy in how we view those sorts of things.
Good luck with that.
Yeah, I don't expect it to happen right now, but certainly every lender views that a little bit differently. One of the things I like about the way our bank works is we have a number of different investors who will take things like that into consideration and interpret them differently, and again, held to the standard of ability to repay. So if the lender says, well, you don't have any payment showing on your credit report, therefore we're factoring zero, you may get the loan under those circumstances.
Very interesting. Yeah. Okay, we're going to cut to our third and final commercial break. Coffee quotes in the movies is the trivia theme. In which 2000 horror movie, since today's Halloween, in which Christopher Plummer plays Matthew Van Helsing, does actor Gerard Butler say, I don't drink coffee? All right? In which, again, let me repeat that. In which 2000 horror movie, Christopher Plummer, who plays Matthew Van Helsing, does the actor Gerard Butler say, I don't drink coffee? All right? Call 888-912-1190 if you know the answer to that one. Don't touch that dial. We'll have some closing comments on the best of investing.
So, by the way, that lender that Bruce was telling me about that did the 1 year's tax returns, picked his highest FICO, and closed in 2 weeks was cash call.
Oh,
and they're never anybody I would consider calling because I hear them on the radio and they just
Yeah.
sound like one of those
So what?
sleazy.
got a
But
good
you know
rate?
anything about them?
No, I don't know anything about them.
all right.
and
Did
their
you have a
guidelines.
good rate, too? I mean,
I think
I think
their rates are really good.
Their
yeah.
rates was good. Yeah, it was probably an easy refinance. It's,
One thing that I learned over the weekend was that MetLife got forced out of the jumbo business because of their appraisal practice. They were doing 2 appraisals and they were sending the investor the higher of the 2.
oh, not sending them both?
Not sending them both.
Wow.
So when that got uncovered,
Not good.
not good.
wow.
They basically just shut it down. They're like, we're not even going to test it. That's it. So yeah, what we do see though, our second mortgage lender, TCF, they will look at the middle FICO of the higher wage earner.
Yeah. Well,
not the lower of the two. So you get some,
I know for me, my TransUnion's off the scale, but the other two are in the low sevens. My TransUnion's been over 800 now for the last 4 or 5 months, and yet my
Those will- others will
Equifax
probably follow suit.
it's just huh?
they'll probably follow suit.
Yeah.
Okay, so you got 9.5 minutes.
Mine and ARF. What articles have we not talked about? We did talk about rates already, so we've got market trends is pretty much.
You want to talk? I think we can go. I can talk about that.
I just know we did
Oh.
kind of talk about rates already. We're just talking about the 15 versus 30 versus the.
This is the only other one I really have that is regulations, but we can get boring on that. But
That's
I don't
true.
know.
Yeah, bore, good radio.
No more. Got a couple of jokes I can tell.
You got a topic you want to start us with? I don't know. I mean,
Let's see. Well, there's all kinds of stuff.
how about the debates?
Just what's happening?
How about the debates?
I don't watch them.
I didn't either, but the candidates.
Oh, right. Which candidates
Which
might
candidate-
be better for?
Be kind of careful though, because we're supposed to be not political.
Yeah, no, I don't have any political bias, but I'm just saying.
Fair enough.
What do you think? Who do you think would be for the real estate industry?
Okay. That's fair enough. Here we go. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. When we come to the third commercial break, we asked this trivia question about coffee quotes in the movies, in which this horror movie happened in the year 2000. Christopher Plummer plays Matthew Van Helsing, and Gerard Butler says, "I don't drink coffee."
These are tough.
Yeah,
I
I don't know. I mean, I liked the movie Van Helsing, which came later, starring the guy,
Van Dam, no.
that Australian actor.
Yeah.
Shoot, I
Can't
can't remember.
That guy.
That guy,
Swinging
yeah. Right.
this. I don't know.
Dracula 2000.
Oh, was it?
Yeah.
Okay,
All right, so Rob, you got kind of interesting take on things here.
I was wondering if you guys had caught the debates earlier this week.
I didn't, and
Because everybody's talking about it, and I didn't catch them either. So I was wondering.
the reason why I didn't watch them is I actually can't stand watching them. I get uncomfortable and start fidgeting in my own seat in my own home watching these guys. It just seems that it's so, I don't know, it seems so disingenuous.
Well, I was captivated by that one comment, I think it was in the first debate, where Marco Rubio came right out and said he would get rid of Dodd-Frank. I don't know if you caught that, but I'm like, wow.
As human beings,
Yeah, baby.
or
Yeah. Look, I mean,
Was
hey,
that a contract
I'm not going to
on
say
him or
anything. Yeah. But I think that there's this in our industry. We're looking at it like, well, if it's a Republican, there's a chance that the regulatory environment could be, fundamentally changed if there's a Republican candidate elected. We don't know if it actually happened. A lot of people think there's no chance that Dodd-Frank's going to be repealed. On the other hand, on the Democratic side, traditionally has been very supportive of bringing new buyers into the market through, housing and urban development, FHA, and all those other programs that enable a lower credit score and a lower down payment. So I think we are, again, here in 2016 looking at, in the housing industry, what do you think is the better play on this? I mean,
So we're real estate guys, and money guys actually. You're a mortgage business.
At the end of
private
the day,
money mortgage. We're also real estate investors, and I wonder, if Trump were to get elected, what would
I can't see it.
I can't see it
Yeah.
either. Even though it would be interesting how it would shake up things.
Yes,
Yeah.
that's true.
Well, how do you think that would affect mortgage rates, money, the real estate? I mean, he's a real estate guy. Made his money in real estate. He understands business. He would be a business president. Ain't no nonsense. Take no prisoners.
Well,
business president.
he's come out and said that the regulators are running the banks, and that's very counter to, the 180 degrees opposite of that is Elizabeth Warren, who feels that the banks are running the government. So, I think that you have two wildly different schools of thought, but what could they actually do? Like, I have no doubt that Elizabeth Warren could really screw things up. I mean, I have to admit, because, she thinks that Dodd-Frank hasn't gone nearly far enough.
That's scary.
Well, here's the funny thing is, Mark, have you benefited by these regulations?
My wife talks about this all the time, and I don't know how to answer this question.
Companies like Pacific Private Money have thrived
Right.
thanks to Dodd-Frank, and that's not necessarily a good thing for the consumer. I'll be the first to admit,
Good
hey,
point, Mark. Good point.
people that
Yeah.
are coming to us, not everyone, but many of our clients come to us because they can't get the bank to do the transaction because of something, some new regulation,
Great point.
thanks to Dodd-Frank.
And I'm gonna speak to the other side of that spectrum, where my average FICO borrower is north of 760,
Yeah.
but the national average FICO is 687. So that tells you a lot of people are not getting access to credit. The average, and so if you want to make regulation tighter and stricter and allow less people to purchase a home or build wealth in real estate and enable their family to have ties to a community, then you can continue to do a good job of that by further restricting access to credit and limiting consumer choice. That's my concern about the Elizabeth Warren train of thought. Whether Donald Trump, again, if Donald Trump ever got elected, could he change that? I don't know, but I think if the mentality changed to say we need to come to a sensible middle ground on regulation, then I think we're more in line. I think that we've also benefited at RPM because our core constituency has a higher FICO score and we're in the Bay Area, but I don't know that that's exclusively,
So you guys like get together and send candy to their houses?
I think that's a RESPA violation now.
Well,
I think we get fined by the CFPB for doing that.
Yeah.
I will say that I'm, regardless, I think we know who's probably going to get the Democratic nomination.
Yeah, I think
none
you're
of
right.
us know who's going to get the Republican nomination right now. I mean, flip,
Wait, do you think Hillary's going to get it?
Yeah, I think it's almost inevitable, and so I
mean, there's nobody else
I
contesting
do
it, right?
I do shudder at the idea of another Democrat president because it just means more regulation, more healthcare
Their
regulation,
stance on it.
more financial reform in quotes regulation. So it's certainly not going to get easier for consumers. They're going to continue to pass more laws in the guise of making it friendlier and easier for the consumer.
And
But we know that the
looking
government
after the
never accomplishes that. They always accomplish. In fact, it's almost always the polar opposite.
Our compliance costs have just gone exponentially higher, and the consumer ends up bearing the brunt of that.
Well, I think Reagan was right when he said,
Yeah.
"I'm here from the government." And
dig them up and bring them back.
Yeah, yeah. It was always be leery of a government person. I'm here from the government. I'm here to help you.
Yeah, that's right. If you like our problems, you should wait to see our solutions, right? The Republican thing, I think, is
That should be the Democrat theme.
Yeah, is a little bit like the wild card. Don't you think it's like you've got these two teams that battle all year, they're front runners and favorites, and then the guys just sneak up at the end, the wild card with all the momentum going to the playoffs?
I don't know, maybe Perot will come back at the last minute.
Is that guy still alive?
Yes,
Oh,
he is.
Yeah, alive and well.
Alive and well.
Wow. All right, we've got just about a minute and a half left, guys.
I think if I go any further down the political rat hole, I'm going to end up getting kicked off the radio.
Yeah, I mean, we've got, you're right, Rob, we've got a year to go before the election.
Yeah, I think.
And probably 6 months before, in the next 6 months, that's what's going to be really interesting. That's when I think you're right. One of the maybe least expected
John Kasich or
candidates is going to come out of nowhere and become presidential enough to be the Republican nominee. At least I sure hope so. I really don't like the way it's going to head.
I'm voting for Pat Paulson again. Or I vote for Taft.
I'm voting for Taft. That's it. I always vote for Taft.
That would be a write-in candidate.
I think Mickey Mouse would be a little bit better choice.
They were still saying 20 years ago, Nixon, tanned, ready, and rested.
Yeah, right.
Tanned, rested, and ready. That's it.
That's a poor thing. That's a poor taste, and I'll stop laughing right now.
On this respectable radio show.
That's
No,
right.
it's very interesting. The political climate, I think, is going to it's going to be interesting to follow that election. We view it very real estate centric. I don't know that it's been discussed enough in the debates. I'll be curious to see who actually ends up getting the front runner.
In a perfect world, it really doesn't matter.
I tend to agree with that.
Or it shouldn't. I'm sorry. It can and it does oftentimes, but it shouldn't. In a perfect world, it shouldn't really matter whether a Democrat or Republican gets elected in terms of a massive swing one way or the other in terms of mortgage rates and business friendliness and all that. But still, I don't know. Politics has gotten so much more shrill lately and so much more divisive that I actually do fear one versus
I tell you
the
what,
other.
if they ever did eliminate Dodd-Frank, repealed it, it would be like walking out of a bomb shelter. in our industry. 'Cause, you know what I mean? We all of a sudden
Yes,
we'd
it
see
would.
daylight, and it would.
Oh,
I
my
mean,
God.
the burden of regulation on our industry governs everything. We
Yeah,
do.
but you know what happens, and then all the little slimy people start coming back out again.
Right,
Sure,
the
but
bad
I-
players.
yeah.
I think our industry has learned quite a bit, and I think that the quality of individual in our industry that is left by all of this is just, it exceeds what people really envision or imagine, and I think very highly of our industry.
Okay,
Yeah.
very good. All right, here's our thoughts for the day. Some people develop a wishbone where their backbone should be. And Ethel Barrymore said, "You grow up the day you have your first real laugh at yourself." I thought that was pretty
That's
good.
pretty good. Yeah.
Tune in next week to the Best of Investing. We're going to be giving away more free vacations for answering trivia questions if you can answer the questions.
Yeah, they're tough.
Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. I was going to tell a joke about, but didn't have time for it. Because we were talking about,
Perfect time
people
for jokes.